All right, here we go. Well, good morning. The show's Money Matters with Greg at WVLP 103.1, and we also podcast and also put this up on YouTube. I'm Greg Farrell, CEO and president of Farrell Wealth. It's a wealth management firm that is local here to Valparaiso, Indiana, but also serving clients all over the nation. And I want to thank everyone for listening in today and checking some things out. We're going to talk about the market. We've had just a crazy week from last week, and then looking at today, what happened with China and the trade talks at the G20 that just recently happened. And the show is Money Matters with Greg. We talk money on this show, anything to do with money, investing, insurance, titling of assets, stock options, as far as compensation for executives, charitable giving, a number of different things we talk about on this show, anything to do with money. And we're just proud to be able to bring it to you here at WVLP 103.1. And it's a local community radio station. And just recently, we went through a money raise in regards to the nonprofit that is this WVLP. And it is just a great community. And I highly recommend that you listen into many of the shows that are on this broadcast on the airwaves, as well as ours, of course. But there's just some fantastic, talented people, and there is an opportunity for you to be able to be on the show in regards to advertising. There is a media kit available as well if you're interested. Please just contact me, Greg at farrellwealth.com, and contact me for anything else as far as questions or anything you might have that you might want to bring or have answered on the show. So it's a half-hour show. And we're a little late today, December 3rd, because if you know me well enough to know that I'm definitely a Deadhead, and I've always followed the Grateful Dead and their music. And the pre-sale tickets went on sale today for Wrigley Field at 10 o'clock. So Greg Kovach, the engineer here today, was nice enough to postpone the show for a few minutes so I could get on the pre-sale and then get my tickets there for Wrigley Field. That's in June, and really looking forward to it. So excited to see Dead and Company come through here in Chicago in the Midwest. Big week here locally with the Bears. Obviously, Chicago Bears, disappointing loss to the hapless Giants, but is what it is, and we hope that we'll be able to turn it around here. We've had the Big Ten championship here in the state of Indiana. That was big, obviously with Ohio State and Northwestern, Ohio State prevailing in that. And moving on to the Rose Bowl, that is big. We've had a number of Big Ten teams make it into bowls, so congratulations to all, and good luck as you go throughout as you go bowling and throughout this season. Want to talk about the market early on, just to kind of bring back what's been going on. We've had obviously a horrible October, down 10% in the market. November was better, and then awful. So right now we're up considerably based on the comments that came out of China and what came out of the G20. I want to talk about that. And then also want to talk about something in the second sections about the 7 questions clients wish their financial advisors would ask them. I want to go through an article that was on wealthmanagement.com talking about some of the things that we see as advisors. We're always trying to ask the right question, I guess, and just continue to ask questions and get into our client's world and understand where they're coming from, truly understand a client for what, for whom they are, what their thinking is, what their psychology is. And it's just a really good article that I'm going to talk about here in the second section. So if you don't want to listen to the market when you're on the podcast, just fast forward, and we'll start that at about the 15-minute mark or so is what we'll try to do. But for now, I want to talk about the risk back on after the clarity of the Fed policy that just recently happened, where the Federal Reserve Chair, Jerome Powell, last Wednesday really brought a relief for investors that the policy would not be as tight as feared, and that really gave everyone some sort of it was a total relief. The market rallied. Global equities, the momentum continued after U.S. agreed to postpone this planned increase in tariffs of over $200 billion in Chinese goods as the two countries really restart negotiations. That was big. That happened on Saturday night. That happened to G20 in regards to the president from China leading conversations with our president Trump, and just trying to figure out exactly where the two sides will meet and how will it be done. They are set to meet in Washington beginning in mid-December, with a focus on this long-standing issues that are trouble the American business leaders, and these include the forced transfer of technology, the intellectual property protection, and cybersecurity. And then it's also expected that China will purchase more U.S. goods in agriculture, industrials, and technology. And this goal kind of came about where the opening of these markets in China will help restore this balance in this global trade. The trade deficit is the largest it's ever been, and data just came out about that. And this is going to hopefully reduce the cost of cross-border commerce. Now, the hardliners may view this truce as a temporary delay tactic, and you really have to view any clarity relative to supply chain disruptions and input costs and tariffs as support for further growth and trade, and more capital investment. But let's note that this conversation that happened in the news you're seeing today is based on a 90-day time frame, and that would end on or around March 1st, which would occur just before China's annual national legislative session. So normally a period where Chinese leaders are wary of making any international concessions. So any escalation of the tariff war would be perceived as embarrassing for the Chinese government leading into this meeting. So it'll be very interesting to see how close to this 90-day number we get. But there are going to be more thoughts on this as these major moving market events really just try to figure it out. Today, we were up well over 300 and some points. We were up on Friday in anticipation of this news as well. So feeling some sort of relief here because, it's been painful. It's been very painful in October. And then to have a 4% rally in the market in the first weeks of November, and then to lose all of that just before Thanksgiving has certainly put people in a bad mood. So nice to be able to see that we had almost a 4%, or if not plus, a 4% rise in the S&P 500 just last week. So feeling like earnings have been fantastic. They were the best they've been in the history, really, of earnings. And also, as far as making money, the big concern has been forward guidance. And believe it or not, as much as you think that some of the things that we read, corporate America really has impressed again. Corporate America has produced just another outstanding earnings season, and we really expect another quarter of earnings growth to be delivered. Look, we thought it was going to be really good. I've been talking on the show that it was going to be a strong quarter, but it was delivered even more than anticipated. It was just tremendous. So third quarter numbers were excellent, and even though the boost from the new tax law was excluded, it's really been the case throughout the year. Revenue and earnings upside compared with expectations was particularly impressive. I mean, earnings growth really kind of looked like we had a peak there for a while, but now we're finding that's sort of premature. And we're also impressed in the resilience of the company's outlooks in the face of tariffs and the ongoing trade policy uncertainty, because that's been a worry in the market, and the market doesn't like any sort of worry. But the S&P 500 earnings rose 28% year over year, exceeding the second quarter's 25% pace, while outpacing the estimates by more than 6%. And that's just huge. This is according to Thomson Reuters data. And index earnings are now have exceeded consensus estimates for 38 consecutive quarters. And this is based on Thomson Reuters data as well, with double-digit growth in 6 of those past 7 quarters. And look, a solid 78% of companies exceeded earnings targets, while the revenue beat rate was 61%. And these are above long-term averages. So even when you're excluding the impact of the new tax law, and you conservatively estimate that it's maybe 7 to 8 percentage points, earnings growth came in at 20%. So a pickup in economic growth, strong manufacturing activities, tax cuts were the biggest drivers of this strong growth. But while this currency translation from the strong dollar has had what we thought was going to be a major impact, but it just has been sort of marginal. It's been marginally negative. And at the sector level, technology, financials were the biggest contributors to the overall earnings increase, while earnings and oil prices helping drive another big increase in energy sector profits. Now, the elephant in the room has been trade, and with some sort of clarity of that over this weekend, we will see how that all goes. We'll be following that very closely in the next 90 days. Want to talk about margins real quick. Operating margins for the S&P 500 companies remain in an uptrend, and this really in part is because of the recovery of the energy sector from depressed oil levels here in 2017. I don't know about you, but I'm really enjoying. We're paying about $2.12, $2.13 a gallon because oil has just been decimated here. And that really, really helps our economy. That helps all participants in the economy. And really want to be able to talk about how nice that is. That's almost like a tax break in regards to going in the holidays and certainly the expenses that come with that. But margin headwinds are building. So the biggest component of corporate cost is wages. And those are rising because there is a tight labor market. Borrowing costs are also increasing as interest rates rise, and tariffs have increased costs for certain manufacturers. So if you input costs, particularly oil, these input costs have been cooperating, and tariffs could potentially go away. But you think it's fair to say that margin expansion opportunities in the coming quarters may be limited. So we'll see what that looks like. But it doesn't mean earnings will grow at a solid pace in 2019, but revenue growth, which is tied to economic growth, may have to do with maybe have some heavy lifting. So the key is what have you done for me lately in regards to the markets? Well, company guidance has been really upbeat, and even though you don't really feel it, or it hasn't been in the news as far as I can tell, but during October to November, the S&P 500 earnings per share estimates for the next 4 quarters has fallen by 1.1%, and that's better than the long-term historical average decline of roughly 2%. So consider ongoing trade policy is this uncertainty and the tax boost overall. But look, the peak is probably in. For the past 2 quarters, market participants really focus on whether earnings growth may have been peaking, and this is not to be confused with peak in absolute level of earnings, but through, even though recent growth rates are unlikely to be repeated in the fourth quarter or in 2019, we still believe the earnings outlook is healthy enough to keep the bull market going through the next year and likely beyond. We'll also keep in mind that the economic recessions historically have not arrived until roughly 4 years after the prior earnings growth peaks. So we'll see. We're keeping an eye on it. Trade's been huge. This is a big trade agreement. The more dovish look in regards to the Fed certainly helped, and we've had a little bit of relief here in regards to the market. So that's my market update. The show's money manager, Greg. I'm Greg Farrell, CEO and President, and registered financial advisor with Farrell Wealth, and LPL Financials, our broker dealer. You can get much of this information from LPL Research at LPL Research on Twitter. You can certainly find us on Twitter as well at Farrell Wealth. And if you're ever looking for, you have a question in regards to the markets or regards to anything to do with money, just email me, greg@farrellwealth.com. I'd love to hear from you. It's always great hearing from our viewers and our listeners. So the show is podcast on iTunes. You can find us there. We just did a 2-part series on blockchain technology, and I hope you enjoyed that. I know a number of listeners have written in and said thanks so much. It was great to get some sort of education on blockchain and what it actually means. And many of these things that you can get on our website at farrellwealth.com. So that's pretty much the laundry list of things to do. I want to talk about what's on wealthmanagement.com in an article by Matthew Regan. He did just a really nice job. I'd love to be able to bring on the show some of the things that I'm either reading or we're reading or discussing or whatever it might be. And I just thought it was a great, as we run our practice and talk to our clients, some of the things that I really enjoy is questioning and making sure that we are asking the right questions at the right times to people that are able to answer them. And of course, being able to make sure that we are asking clients questions that they really would like to have us ask. We really, in order to be able to truly understand clients' goals, you really have to truly understand the client. So financial advisors really sort of, in our world, we really see we need an edge. I mean, the industry has been changing. The battleground for keeping and growing a book of business is fought on really 2 connected fronts. You talk about providing better wealth management experience and deepening client relationships. Winning that battle with clients, is really about asking great questions. And for many advisors, early interactions with clients amount to little more than fact-finding. This sort of introduction, these list of introduction questions or checklist to ask clients about standard risk tolerance questionnaires, time horizon, expectations in a portfolio, all of these other things that you talk about goal-oriented approach. They sort of often fail to develop the real strategy for these meetings. Now, if you ask great questions, it should be a centerpiece of early conversations with the client, but then also build on these conversations, go back to them, revisit them. Great questions give advisors really that glimpse beyond a client's goals into his or her personality, their priorities, family, preferences, all of those things that really matter that deepen a relationship. So some of the things that in this article from wealthmanagement.com that Matthew Regan asked there are broad ways to facilitate a better wealth management experience for clients. And one of those is to ask open questions. I mean, he suggests to ask open questions, avoid yes and no questions as much as possible, get personal, be an active participant. Obviously, don't just sit there on a bump on a log, but be part of the conversation. But some of the questions that clients in a survey that they did said, I really wish my financial advisor, I wish they would ask me a couple questions. Now, one of those is a little self-centric, and that would be, why did you choose to work with me? Most people speak to a number of advisors before ultimately deciding on a financial partner, and that's the right thing to do. You should be talking with multiple people. Getting insight into why a particular client review, sort of why they accepted you or why they revealed, is a really good idea for advisors to ask. And then obviously having good follow-up questions. But you may have recently left an advisor they weren't happy with. In either case, you kind of want to find out as much as you possible that what can be brought to them as a relationship, what was missing in a relationship to be ultimately be a part of your organization. Another question that they recommend to ask, or that clients recommended to ask in the survey, is, what are the 3 financial milestones you're planning for? This is extremely important because most advisors really default to ask about retirement goals and timeline. But this retirement tunnel vision really often results in advisors overlooking key planning priorities, and that would be charitable giving goals. What about giving to charity in your lifetime? Is it important to you to have a name on a building, or to not even go that far, just um, uh, have the acknowledgement in this lifetime for your your charitable inclinations? What are your charitable giving goals? What about travel and college planning? Where do you want to? Where have you always wanted to visit? Do you want to travel? When do you want to travel? What time of year do you want to travel? You really want to be able to make sure you're asking these conversations, and sort of as an advisor, separating yourself from advisors by asking a client to kind of rank these milestones based on what's most important to them. And when the conversation does turn to retirement, you're asking the client what are you looking forward to most? Just because you retire doesn't mean you die. I mean, this is all about living. And the answer really, talk about family, you talk about travel, talk about hobbies. Uh, how are we going to pay for all this? Um, is really, really important. So, another question what would you do if you were forced into early retirement? Well, plenty of people look to retire as early as they can. I mean, everyone I meet certainly wants to retire. If you're in your 40s, you want to retire in your 40s. If you're in your 50s, you want to retire in your 50s, and so on. But employers may force clients to retire before they plan to, and they never necessarily thought about it, whether it be health issues facing a client or family members. That might actually compel them to stop working. So, one Morningstar report concluded that the median retirement age is 61 rather than 65. Now, those 4 years can make a huge difference. So, you can really talk to a client and grab someone's attention by mentioning potential disruptions in to retirement plans that really start the conversation about contingency plans and priorities and trade-offs and whatnot. So rather than focusing on a single static goal like retirement age, advisors and clients really should look towards the goals in terms of an ideal and acceptable outcomes. And that's really what a client really wants, is ideal versus that they'll be okay with just acceptable. They want a really good retirement. Everyone wants that. So we know that everyday life has a way of turning most goals into moving targets. So plans must be flexible. You must really work together. And advisors should know that client priorities are really nice to have, of which most need to have, and to be able to map these various scenarios within a client's comfort. We always talk in our firm about making a plan, working the plan, and that's what my dad always used to say to me, and I live my life to this day with those words that resonate with me daily. Um, just because you made a plan and you're attempting to work the plan doesn't mean the plan can't change, and it does have to change at times. Where I really had this plan in mind, but something happened. One of my family members became ill. My company was just purchased. There's a takeover. There's a merge in my workplace. What exactly? How will that plan change, and how will we adapt? Another question I think is really good is, can you tell me the difference between active and passive management? Now, I won't go into extreme detail about this, but getting a handle on a client's financial knowledge is a crucial early step in understanding. Some people are extremely knowledgeable in regards to this, and some people just don't care. They want to be taken care of. They want to be able to know that they're in a good place, and they want to be able to make sure that are out there in regards to education on passive or active management. A guide to how advisors should talk about investments is really in the context of client goals and what financial details really require. Um, so the difference is, one, you have no management, you have no manager, you don't pay for that. You have a passive investment vehicle like the Vanguards or the iShares or ProShares or PowerShares, and you do not pay for that manager, so you follow along the index along with um, everyone else. Where if you have an advisor that is managing, or if you have mutual funds, mutual fund managers that are managing, or a separately managed account that is managing, um, Are you interested in that? And then having an education about what those are and what that looks like, difference between passive and active. So one of the questions people would really appreciate their advisor asking them is, what is the difference, and do you understand that there is a difference? Another question is if the market were to crash tomorrow, would you see that as a threat or an opportunity? Now, creating an accurate risk profile relative to a client's goals is one of the primary objectives of initial conversations with all new clients. It's very, very important to get and understand everyone's tolerance for risk. And the question that provides insight into this personal investment philosophy is this true tolerance of risk. People say that they're able to tolerate risk, and then October happens in 2018, and we drop 10%, and people freak out. So is this an opportunity, or is this something that I just can't handle? It really also shed lights on the goal priorities in the life stage. If you are in for the long haul, and you truly are in for the long haul, these short volatile blips will not necessarily affect you. Someone needing liquidity in the near future will have to offer maybe a different perspective on a potential market downturn. But is it an opportunity? Ask your advisor. Is it an opportunity, or is it a threat? And what are your thoughts as far as if the Dow dies 500 points tomorrow? What exactly is our plan? Next question is, what health conditions run in your family? Many clients wish we would ask these things, and that's why I bring them up. Healthcare costs can be a major source of stress, particularly as retirement approaches, and it's not hard to see that a couple retiring this year will spend an average of $280,000 on healthcare costs during retirement. That's according to research from Fidelity Investments. Look, it's expensive. I mean, don't kid yourself. Healthcare costs are rising. They're rising every single year, and they're extremely expensive. So being able to make sure that you don't underestimate the cost of caring for yourself or your aging parents is extremely important. And these are questions that should be asked, and that advisors really can anticipate the savings need for potential healthcare costs. Better positioning, recommended approach, maybe products that work for you, that may provide long-term peace of mind. How do you feel about assisted living facilities? How do you feel about staying at home? What are your thoughts about your parents? Have you handled healthcare expenses with your parents? These are huge questions. And then the final question, the seventh question, is what keeps you up at night? This is an easy one. It's hard to ask clients to face their demons, but what puts you in a vulnerable state, sometimes this uncomfortable place, to which advisors we all try to make great efforts to avoid. That's why we do what we do as a financial advisor. It's why we ask the questions we ask. And without understanding the source of your client's financial stress, it's really nearly impossible to deliver a plan that sort of alleviates your fear. So you have to ask the question, and addressing these fundamental concerns with clients, it starts that conversation to dig deeper and reveal these true motivations of their goals. What are your goals? What are your plans? What are your fears? Let's work through it. Okay? So those are the 7 questions that you can find on wealthmanagement.com. For that clients wish their advisors would ask. I just thought it'd be a really good follow-up and sort of bring to everyone out there. If you have a financial advisor, I highly recommend you ask those questions and bring them up to them. Don't wait for them to ask. Go ahead and ask yourself. It's kind of like when you're taking care of your health care and your health, it's important that you ask the questions of your doctors. Make sure you're going after and investigating the education. You're educating yourself as much as possible. They are your advisors. They're there for your guidance. They're there to guide you. They have the expertise. But go ahead. Don't be afraid to ask the questions. So those are 7 questions clients wish their financial advisors would ask. Again, you can find it at wealthmanagement.com. You can also follow wealthmanagement.com as well. Matthew Regan is the author. It was written November 5th, 2018. So I hope you're able to follow up on that. We've talked about the market. We've talked about the questions you're hoping that your financial advisors would ask. The show is Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth, it's a wealth management firm here locally in Valparaiso, Indiana. We want to thank WVLP 103.1 FM, as always. Thank Greg Kovach for being the engineer today, for the opportunity to be able to be on this this station. I highly recommend that you listen to other shows. You can find it at wvlp.org. There are some fantastic shows as well. And then if you're interested in contributing in any way, whether it be through the media and the media kit or just donations to a nonprofit, we'd love to hear from you. Just write me at greg@fairwealth.com, and I'd be happy to help you out as far as guidance in regards to that. Again, thanks again for listening. The show's Money Matters with Greg. You can find us on iTunes. This would be podcast as well. You can also see our videos on YouTube channel, pharaohwealth.com, or Pharaoh Wealth on YouTube. So you can see our new videos that come up. We have a green screen, and basically it's my face for radio out there on YouTube. Trying to be a YouTuber and hang with these millennials as much as I can. I want to thank everybody for listening, and look forward to talking to you next week. Have a great December 3rd, and have a healthy and profitable week. We'll see you.